Hello, I'm Professor Brian Boucher. Welcome back. In this video, we're going to continue our look at discretionary expenditure models. I'm going to introduce two refinements that will help us better use these models to detect earnings management. One will be something called the distance measure, which will help us understand a manager's motives to manipulate earnings using a given expenditure. And second, we'll look at quarterly changes in the expenditures to help us find earnings management. Once we go over those refinements, I've got three brief cases to show you how all this stuff will work. Let's get started. So we need to do some refinements to the discretionary expenditure models because they're very imprecise. We still haven't addressed the problem that the economics of the firm may have shifted, which warrants a legitimate change in expenditures, making it harder to spot manipulation using discretionary expenditures. So our first refinement is we're going to come up with something called a distance measure, and I'll show you that in a little bit. But this distance measure will help us identify companies' earnings management motives during the year. So one type of company the distance measure will help us identify is a company that would miss its earnings target without a cut in expenditures. For example, unless they cut their R&D expense by, say, 2%, they won't meet their earnings target. We're going to call these meet or beat firms. So their incentive is to cut their expenditure just that little bit so that they can meet or beat their earnings target. The distance measure will also identify a company that would miss its earnings target even with a cut in expenditures. So this means that you may be able to, that if you cut your R&D all the way to zero, you would still miss your earnings target. It wouldn't be a big enough savings in expense to meet your earnings target. We're going to call these big bath firms. Here the incentive is to increase their expenditures to make a bad year even worse, but save future expenses. For example, if a company accelerated its R&D spending, so things it planned to spend on next year, it spent on it this year, it would make its bad year even worse, but it's still a bad year. But what it would do is it would help the recovery the next year because next year's R&D expenses would be lower and earnings higher because you've accelerated some of those into the current period. And the last group we can identify with the distance measure would be a company that would make an earnings target even with an increase in expenditure. So the company could increase its R&D by 3% and still meet its earnings target even with a higher expense. We're going to call these smoothing firms. Here the incentive is to increase your expenditure to make a great year just a good year, and then again save future expenses. So if you increase R&D from 3% to 5%, it still allows you to make your earnings target, and what you've done is you've saved some expenses in the future, helping next year's results. So that's what the distance measure is going to help us do. The second refinement is to use quarterly expenses to identify unusual changes late in the year. As we've talked about before, normal business activities should cause changes to happen throughout the year, but earnings management is more likely to cause the changes to be concentrated late in the year when the manager realizes they need to do something to manipulate earnings.
Another oxymoron. I have been to Bath and it is certainly not big.
This is not referring to Bath, England. I've never been able to find a definitive source for the origin of this term. What I've heard is that it's a reference to the fact that companies used to write losses in red ink, so profits would be written in black ink, losses in red ink. And so a loss meant the company was taking a bath in red ink. And so a big loss would be a big bath in red ink. So big bath means big loss. I mean, whatever the origin, it's become a well-established term for incentives to take a huge loss this period in order to try to make your earnings look better in future periods. Let's take a look at how to calculate the distance measure, and we'll look at R&D first. So the distance measure is equal to the current period's pre-R&D earnings minus the prior year's pre-R&D earnings, all divided by the prior R&D expense. When I say pre-R&D earnings, what I mean is the pre-tax income plus R&D expense. So we remove R&D from pre-tax income to see what the income would be without any R&D spending. And then you can also do this for SG&A and advertising. You just replace R&D with one of those two. So here's an example of how it's calculated. Let's say in 2014, pre-tax income was 500. 2015, it's 505. R&D expense was 90 and then 84. So if we add pre-tax income and R&D expense, we get 590 in 2014 and 589 in 2015. So the distance measure in this case would be 589 minus 590 divided by the prior R&D expense of 90, which is negative 0.011. The way to interpret that is the company would need to cut R&D by 1.1%, say from 90 to 89, to equal last year's earnings. And you can see this in the table. If they had cut R&D from 90 to 89, their pre-tax income would have been 500 and they would have just met last year's earnings. Now, as it turns out, they cut R&D by more than that, and what it did was it allowed them to take what would have been a decline in pre-R&D earnings and turn it into an increase in pre-tax income. So the companies that we're going to look at as meet and beat incentives will be ones where the distance measure is between 0 and negative 0.20 or negative 20% or so, because in that case, the company could cut R&D enough to meet its earnings target.
I love the exacting imprecision of minus 20 or so. My sister says one should always avoid strikingly soft demarcations.
Exacting imprecision, nice use of oxymoron again. Yeah, so I don't know where this cutoff is. I do know that at some point, if a company cut too much R&D, then they're destroying the company's value because they could be sacrificing investment in projects they need to perform well in the future. And if they cut too much, it's just going to simply be very noticeable to investors and they'll see right through it. So I don't know where the number is. It's probably the case that some companies have cut 25% to manage earnings, whereas other companies have needed to cut 15% but didn't because they thought it was too large. This is going to be somewhere in this neighborhood, and it's going to be exactingly imprecise. Anyway, a big bath incentive would be indicated by a distance measure that's less than negative 0.20 or so less than 20%, because in that case, the company could really not feasibly cut enough R&D to meet their earnings target. Sure, they may be able to cut 40% of their R&D or 80% of their R&D to meet the target, but then that would also be very obvious to people, which would not make it a very effective way to manipulate your earnings. And then finally, the distance measure will indicate a smoothing incentive anytime the distance measure is greater than 0, because in that case, the company could increase R&D and still meet its earnings target. Second refinement we're going to look at are quarterly changes in these expenditures. Some firms report quarterly amounts of expense. I say some firms because it's not mandatory. It's essentially a voluntary disclosure. To give you a sense of how voluntary it is, in 2015, about 95% of companies reported quarterly SG&A, because that's somebody that all investors want to see, even though it's not required. About 30% of companies reported quarterly R&D, and nobody actually reported quarterly advertising expense. So we can't use it for advertising. We're going to look at our year-over-year change, or our YOI change, which would be the expense this quarter minus the expense the same quarter the last year, divided by that expense the same quarter the last year. If discretionary expenditures are used to manipulate annual earnings, we would expect that the YOI change in the fourth quarter is different than the other 3 quarters. So for the meet and beat incentive, you would expect to see cuts in R&D in the fourth quarter as they try to meet their target. Whereas for big bath or smoothing incentives, you might see a big increase in R&D in the fourth quarter as they realize they should accelerate some of these expenditures to make their earnings lower this year, but help their earnings next year. So we want to look at the pattern of quarterly changes in these expenses when available in conjunction with the discretionary expenditure measures and the distance measure to get the most complete evidence on whether there might be manipulation going on.
Can we make any definite guesses about earnings management based on whether companies transparently hide their quarterly or R&D?
Excellent question. I think the big thing that determines whether a company discloses quarterly R&D or not is how important R&D is for the company. So companies where R&D is a huge part of their business, investors will demand the information on a quarterly basis and the companies will provide it. Companies where R&D is not as important, there's not as much demand to see it quarterly and you won't see it. Now, if a company did start disclosing it quarterly and then stopped, that would be very suspicious to investors. They would try to figure out, hey, why are they taking away this disclosure? And the inference would be that maybe they are trying to manipulate. So for that reason, if a company really was trying to manipulate its R&D, it would probably still continue to disclose it so as to not raise immediate suspicion as to what it's doing. So we tend to see that companies, once they report quarterly R&D, tend to always do it. And so we're going to look at the quarterly changes to try to make attributions, not whether they report it or not. Now we're going to look at a number of cases to illustrate how to use these tools. And instead of making you wade through all the data in a spreadsheet, I've pulled summaries into PowerPoint to make it easier for us to look at. The first case is a company that had a possible meet or beat incentive to manipulate their expenditures. And in each case, we're going to look at research and development. So this is Dog Techno Corp. In 2013, they had a negative discretionary R&D measure, which was a bigger negative than in the past. So that means they spent less on R&D than expected, potentially cut it to manipulate their earnings. If we look at their distance measure, it was a very James Bondian negative 007. What that means is that if they cut their R&D by just 0.7%, they would have reversed their pre-R&D earnings decline and made it a positive change in pre-tax income. So they're very close to their target. If we look at their quarterly changes in R&D, you can see that the quarterly changes get smaller each quarter and then are actually negative in quarter 4, suggesting they cut R&D relative to the prior year in quarter 4. And in the last column, it's the change in pre-tax income divided by revenue, just scaling it to make it easier to look at. So if this is positive, it means their income was higher than last year. Negative means it's lower. And sure enough, they meet their earnings target this year. And this would be a pattern which would suggest a cut in R&D in order to meet your earnings target from the prior year. Second case is a possible big bath situation. This is Rexito Corp. So if we look at their discretionary R&D in 2007, it was a big positive number, much bigger than in the past, which means they spent more on R&D than expected, which is going to reduce their earnings. If we look at their distance measure, it was negative 0.634, which means they would have to cut R&D by 63% in order to meet their earnings target, which makes it a potential big bath. And then we look at the quarterly changes. The quarterly changes get bigger each quarter, and then it's an enormous 435% increase in R&D in the fourth quarter. And sure enough, the last column shows that they missed their earnings target by a lot. Their earnings were down by 13% of revenue versus the prior year. So this would be consistent with a big bath. They knew they couldn't meet last year's target, so they accelerated some of next year's R&D into this year to make the bad year worse, but then hopefully help their turnaround in the following year. And then the last situation is a potential smoothing situation. The company we're going to look at here is Endogtha. They also had a big positive R&D, discretionary R&D in 2006, indicating they spent more in R&D than expected. Their distance measure was 0.935, which means they could increase their R&D by 93% over the prior year and still have an increase in earnings. When we look at the quarterly pattern, we see a big increase in YOI R&D in the fourth quarter. And in the last column, they still did meet their earnings target. They were 5.8% of revenue above last year's pre-tax income. So this is consistent with smoothing, where they made a great year a good year by accelerating some R&D expenses from next year into the fourth quarter of this year to reduce earnings, but then save some expenditures for the future. And that wraps up our look at discretionary expenditure models. So you have another tool for your toolkit in detecting earnings management. In the next video, we're going to take a different approach to trying to look for manipulation. We're going to look at models that take a look at firms that we know have committed fraud, compare them to firms that didn't commit fraud, and try to see what makes them different. What makes them different are variables that we could use to potentially predict fraud. I'll see you next time.
See you next video.